it's difficult. The fundamental economic principles make it difficult. We're talking about businesses that didn't exist last year or the year before, that now do, and are trying to do something in the future that may or may not work. So the uncertainties are enormous. So that makes it hard to be purely scientific about valuation. You know, if you've got a business that's been around for 15 years and is throwing off cash, and there are obvious market comparables, you can do discounted cash flows and come to a pretty reasonable number. You can argue about whether you use a X discount rate or X plus 1 or less than 1 discount. You can make it pretty refined. We're in the, you may make a lot of money, you may lose all your money in these investments. So it is highly uncertain. So we start with this question that I mentioned before of, is it worth it? And we define our is it worth it with the following parameters, which I'm happy to talk. I mean, there's nothing secret about this. For this asset class of investment, it's higher risk than stocks and bonds and all. So we're expecting a superior return to take those risks. On a portfolio basis, mid 20%. So it's kind of the thing of 25%. To get there, you know, like in any investment, you can buy the stock of a company and it goes up and down, and you take that risk and it goes up and down. Or you can buy a lot of company stocks, or a mutual fund which buys even more, and reduce the amplitude of variation in that, which gives you a greater sense of confidence. Even in this high-risk asset class called early stage investing, you still do that. You do diversification of your investments, because if you're taking a risk where you can lose 100%, you have one, you know, you're at real exposure. If you have two, well, one might do okay and the other might not. So you get to portfolio theory, and a typical portfolio sort of standard is 10. And if you have 10 companies in your portfolio, you might lose all your money on one or two, but you can sustain that if you get your money back more or less on most of them, and one or two are big winners. It's a fundamental way of looking at this, whether you're an angel or a VC. So you're looking for a winner in your portfolio. The problem is you can't really figure out which is going to be the winner and which is not. So you behave as if you select only winners, but you still have to have the return for whatever winner based on 1 out of 10, 2 out of 10 maybe. So the economics drive you to, if you want a 25% return on a portfolio, to the mid-50s to kind of get you there. So you can simply back into arithmetically back into this. If we're looking for a 50% per year return over 7 years, that means you're going to need 10 times your money. So you put in $1 million, you need to get 10 million out 7 or 8 years later. If you're going to get $10 million out and you own 25% of the company has to be sold for $40 million. You get the 10 because you got 25%. The entrepreneurs get the other 75%. So what does the company have to look like if it's going to sell for $40 million in 7 or 8 years? And then you look at multiples in the market and a variety of things. That's your basic arithmetic. It isn't hard. If you can't get there in any simple form, we're not interested. A lot of entrepreneurs don't know that. We have here in Arizona, the problem in my view is that the community is so diffuse that the regular flow of gossip on these kinds of things that you would find in Silicon Valley doesn't occur, so people don't know. You know, if I pitched to a venture group and they said, no, your valuation is out of the ballpark by X, we'd have coffee and we'd talk about it, and I'd tell you what I learned for your business. So you now have an incremental piece of information that you can process for when you go pitch to that VC or another one or whatever. We don't have that. So people connect the dots that they have. And usually these are dots of somebody talking about some wildly unusual situation, whether it's Facebook or Pinterest or any of these kinds of things. And so people, I'm going to be just like that. And those are not valuable examples. So it's not that people are stupid. People are, in this case, are smart. They're just assembling facts that are the wrong ones. So we talk about valuation all the time. And one of my friends says he's never seen a valuation that's been too low. He's probably right. Entrepreneurs have a misunderstanding of what it is that they have and what we're interested in. So use my numbers. That's going to get us interested. This isn't a surprise. It isn't greedy particularly. It's just what it is. So now you line that up against how entrepreneurs think about their businesses. And first thing you get is, well, I put all these hours in it. I worked for free. Okay, so you worked for free for a year. So let's figure this out. Standard work year is 2,040 hours. We'll make it easy. We'll say it's 2,000 hours. Give you extra vacation. And you think your time's worth $300 an hour. So you think that your value of your time in your business is worth $600,000. I get that. We value that at zero. And it's not going to change because every entrepreneur does exactly the same thing. So the market is cleared. We'll look at the dollars you put in as a basis for something. And then we talk about, use my example. If we get $10 million at the end of the deal, the company sold for $40 million, let's eliminate some transaction costs. All the rest go to the entrepreneurs. And if we put $1 million in a company, typically the entrepreneur's going to have $100,000 maybe in it at best. So look, you put $100,000 in your business and 7 or 8 years later you walk away with $30 million. Is that bad for you? But I've got all this time in it, and so I'm only going to give you 5% of my business. No, you're not going to give me anything. I'm going to buy something. And if I don't get proper value, I'm not going to buy from you. I'll buy from somebody else. So it's not even a zero-sum game, and it's certainly not hostile. It's about trying to understand the motivations of the people who are providing the money into a situation so the entrepreneurs can do real well as a result.